Over the next 35 to 40 minutes, we're going to unpack one of the most widely used tools in a trader's toolkit. Bollinger Bands, the three wavy lines you've probably seen wrapped around a price chart, squeezing together at some points and stretching apart at others. Here's our path for today. We'll start with a quick look at what Bollinger Bands actually are and the simple idea behind them. Then we'll spend the bulk of our time on the real heart of this lecture, how to interpret what the bands are telling you, since that's the part most resources rush past. From there, we'll walk through 4 hands-on trading techniques you can start practicing right away, and close with the common mistakes beginners make, a word on risk management, and a quick recap. This is a beginner-friendly session, so no prior charting experience needed. By the end, you'll know what those 3 lines mean, how to read them, and how to actually put them to use. Let's get started. Bollinger Bands were developed in the early 1980s by a financial analyst named John Bollinger. Before this indicator existed, traders often used fixed percentage bands drawn a set distance above and below a moving average. The problem was that markets don't move at a constant, predictable rate. Some periods are calm and quiet, others are wild and chaotic. A fixed-width band couldn't tell the difference between the two. John Bollinger's insight was simple but powerful. Instead of a fixed percentage, let the bands widen and narrow automatically based on how volatile the market actually is right now. That one idea is still exactly how the indicator works today, more than 4 decades later. I won't spend much more time on history, because I'd rather get you to the practical material, but I do want this one fact to stick with you. This indicator was built specifically to measure volatility, not to predict which direction price will move next. Hold on to that thought, it's going to come up again and again today. So, what is it exactly? A Bollinger Band is an overlay that sits directly on top of your price chart, made up of 3 lines. There's a middle line, which is simply a moving average of price. There's an upper line sitting above it, and a lower line sitting below it. Picture price moving inside a channel, with the upper and lower lines acting like the walls of that channel. When the market is calm, those walls squeeze in close together. When the market gets volatile, the walls stretch far apart. That expanding and contracting motion is what makes Bollinger Bands so visually useful. You can literally see the market's volatility shift in real time just by glancing at how wide or narrow the bands are on the screen. That's the whole concept in a nutshell. Now let's look at exactly how each of those 3 lines is built. Here's a closer look at each one. The middle band is a 20-period simple moving average. On a daily chart, that means it's the average closing price over the last 20 trading days, roughly the last month of activity. The upper band takes that same moving average and adds 2 standard deviations to it. The lower band takes the moving average and subtracts 2 standard deviations. So really, there are only 2 ingredients in this whole indicator, a moving average and a measure of how spread out recent prices have been. That's the standard deviation piece. The moving average gives you the center of gravity for price, and the standard deviation tells you how far price has been wandering away from that center recently. That second ingredient, standard deviation, is worth unpacking next, because I know the phrase can sound intimidating. It really isn't. Standard deviation is just a way of measuring how spread out a set of numbers is from their average. That's genuinely the whole concept. Here's an everyday example. Imagine 2 students who both average 80% on their tests. Student A scored 78, 80, 82, 79, and 81. Very consistent, tightly clustered, right around 80. Student B scored 60, 95, 70, 100, and 75, the same average, but wildly inconsistent from test to test. Student B has a much higher standard deviation because their individual scores are more spread out from that shared average. Now apply that same idea to stock prices. If a stock has been trading in a tight, calm range recently, its standard deviation is low, and the bands squeeze in close to the moving average. If a stock has been swinging wildly up and down, its standard deviation is high, and the bands stretch way out. That's genuinely everything you need to understand about the math behind this indicator. You don't need to calculate any of this by hand. Your charting platform does it instantly, automatically, on every candle. What actually matters is understanding what the number represents. Recent price volatility, translated into a visual width on your chart. Before we go any further, I want to plant one idea firmly in your mind, because it will save you from the single biggest mistake beginners make with this indicator. Bollinger Bands are a volatility indicator. They are not a direction predictor, and they are not, by themselves, a magic buy and sell signal generator. What they tell you is this: how volatile is the market right now, and where does the current price sit relative to its own recent average? What they do not tell you, on their own, is which way price is going to move next. Every single technique we cover today builds on top of this idea. If you remember only one sentence from this entire lecture, let it be this one: the bands describe the current state of the market. Your job as a trader is to interpret that state, add context, and combine it with other information before making any decision. We're going to come back to this idea constantly, so keep it in your back pocket. Let's start really digging into interpretation, because this is where the actual value of today's lecture lives. The very first thing to check on any chart is bandwidth, simply how far apart are the upper and lower bands right now. When the bands are wide apart, that tells you the market has been volatile recently. Maybe there's been a news event, a strong directional move, or just a lot of back and forth choppiness. Either way, price has been swinging a meaningful distance from its average. When the bands are narrow and pulled in tight, that tells you the market has gone quiet. Price has been trading in a small range, and recent volatility has dried up. Here's the interesting part, and it's something you'll notice the more charts you look at. Markets tend to alternate between these two states over time. A period of very low volatility is very often followed, eventually, by a period of higher volatility, and vice versa. Traders have a specific name for an extremely narrow band period. They call it the squeeze, and it's one of the most closely watched setups in all of technical analysis. Because a squeeze often comes right before a significant move. We're going to build an entire trading technique around exactly this idea a bit later, so keep this concept close. Let's imagine a hypothetical stock. We'll call it ABC Corp, just to make this concrete as we go. If ABC Corp's bands have been unusually tight for the past 2 weeks, that alone tells you something important. This stock's recent volatility is unusually low, and that's worth paying attention to, even before we know anything else. The second thing to read is a little more intuitive. Where is the current price sitting relative to the bands themselves? If price is up near the upper band, it means the current price is relatively high compared to its own recent average and its own recent volatility. Some traders describe this as overbought territory. If price is down near the lower band, price is relatively low compared to its recent average. Some traders call this oversold. Now here's the trap that almost every single beginner falls into, and I want to call it out directly. They see price touch the upper band, and they immediately think, sell, it's overbought. Or they see price touch the lower band and think, buy, it's oversold. This is the single most common Bollinger Band mistake in existence, and I want you to unlearn it right now if you've picked it up anywhere else. Touching a band is not, by itself, a signal to do anything. All it tells you is that price is currently sitting at a statistical extreme relative to its own recent behavior. It says nothing about what happens next. In fact, in a genuinely strong trend, price can sit right on a band for a long stretch of time without reversing at all. We'll unpack exactly that situation next, because it matters a lot. In a strong, sustained trend, you will often see price ride right along the upper band, candle after candle, in an uptrend, or ride along the lower band, candle after candle, in a downtrend. Traders call this walking the band. Think about what would happen if you had assumed that touching the upper band automatically meant overbought, time to sell. In a strong uptrend, you would have sold far too early and missed out on a large continuation move. Worse, if you had gone short based on that single touch, You could have taken a real loss fighting against a healthy, strong trend. So how do you actually tell the difference between price is walking the band in a healthy trend and price is at a genuine extreme and likely to reverse? This is exactly the kind of judgment call that separates more experienced traders from beginners. And honestly, it's why we never read Bollinger Bands in total isolation. We always want to look at the broader trend first and ideally bring in a second, independent confirming signal before drawing any conclusion from where price sits on the bands. This idea, reading the bands in context, rather than treating any single touch as an isolated signal, is exactly the bridge we need to move from theory into practice. Let's shift gears now and walk through 4 real trading techniques built on everything we've just covered. Our first technique is called the squeeze, and it builds directly on the bandwidth concept we discussed a few slides ago. Here's the setup. You're watching a chart, and you notice the bands have pulled in tighter than usual, much narrower than their recent typical range. This tells you volatility has dropped to an unusually low level for this particular market. Historically, these low volatility periods tend to resolve into a sharper move, because markets rarely stay quiet forever. It's a bit like energy building up in a coiled spring. Here's the part beginners consistently get wrong. The squeeze tells you that a bigger move is likely coming soon. It does not tell you which direction that move will go. So the technique is never simply buy when you see a squeeze. Instead, the process looks like this. Step 1. Identify the squeeze bands pulled in noticeably tighter than usual. Step 2. Wait. Resist the urge to guess the direction. Let the market show its hand first. Step 3. Wait for an actual breakout price, closing decisively outside one of the bands, ideally accompanied by a burst of increased trading volume, which adds confidence that the move is real rather than a brief flicker. Step 4. Only after that breakout is confirmed, consider entering in the direction of the breakout, not before it. Our second technique comes directly from John Bollinger's own original work, and it's a pattern-based approach to spotting potential reversals. Let's talk about the W bottom first, since it's used to spot potential upside reversals. Here's the pattern. Price drops down and pushes right to, or slightly outside, the lower band, that's the first low. Then price bounces back up, typically toward the middle band. Then price comes back down for a second low, but here's the critical detail. This second low stays inside the band this time, even if, in raw price terms, it's a similar level to the first low, or even slightly lower. That detail matters enormously. The second low occurring inside the band, rather than piercing outside it again, suggests that selling pressure is actually weakening, even though price tested a similar area. That weakening pattern traces out a rough W shape on the chart, and it's often followed by a move higher. The M-top is simply the mirror image, used to spot potential downside reversals. Price pushes up to the upper band, pulls back, then pushes up again, but this second push fails to reach the band, tracing out a rough M shape. That weaker second push suggests buying momentum is fading, even though price is making a similar high. I want to be very clear here. This pattern suggests a reversal is more likely it is not a guarantee, and it will fail sometimes. Like every technique today, a W bottom or M top works best when it's combined with additional confirmation, which is exactly where we're heading in a couple of slides. Our third technique is called the Bollinger Bounce, and it's designed for a very specific market condition, a sideways, range-bound market, not a trending one. That distinction is critical, so please hold on to it. There's a concept in statistics called mean reversion, the idea that prices tend to gravitate back toward their average over time, especially when there's no strong trend actively pushing them in one direction. John Bollinger himself noted that in genuinely ranging markets, price tends to bounce back and forth between the upper and lower bands, almost like a ball bouncing between two walls. Here's the technique. When a market is clearly ranging no strong trend, bands relatively stable rather than steadily expanding in one direction, traders will look to buy as price approaches the lower band, targeting a move back toward the middle band or even the upper band, and they'll look to sell or take profit on a long position as price approaches the upper band. Now here's the critical warning, and it connects directly back to what we covered with walking the band a few slides ago. This technique only works in genuinely ranging markets. If you try to apply the Bollinger Bounce during a strong trend, you'll end up buying dips in a downtrend or selling rallies in an uptrend, and that's a great way to take a series of losing trades. Always check the broader trend first, before assuming you're in bounce-friendly conditions. Our fourth technique isn't really a standalone pattern on its own. It's a principle that should sit underneath everything else we've discussed today. Bollinger Bands work best when they're combined with a second, independent indicator. Why does this matter so much? Because Bollinger Bands are fundamentally a volatility and price location tool. They don't directly measure momentum. So pairing them with a momentum-based indicator, something like the RSI, the Relative Strength Index, or the MACD, gives you a second, independent perspective on the exact same moment in time. Here's a simple example. Let's say price touches the lower Bollinger Band. On its own, as we discussed earlier, that's not a signal by itself. But now let's say the RSI is also showing a genuinely oversold reading at that exact same moment. Now you have two independent tools, one measuring price relative to volatility, one measuring momentum, both pointing toward the same conclusion. That's a meaningfully stronger case for a potential bounce than either signal would be on its own. The same logic applies directly to the squeeze technique from earlier. Many traders wait not only for the breakout candle, but also check that volume is expanding or that a momentum indicator is turning in the same direction as the breakout before actually entering a trade. Layering these confirmations together doesn't guarantee a winning trade, nothing does, but it meaningfully reduces the number of false signals you'll end up acting on. Let's tie all four techniques together into one simple mental checklist you can run through anytime you pull up a chart with Bollinger Bands turned on. Step 1. Check the band width. Are the bands squeezed tight, wide and expanded, or somewhere in between? This tells you the current volatility state. Step 2. Check the broader trend. Is price in a clear uptrend, a clear downtrend, or trading sideways? This tells you whether walking the band or range bouncing is the more likely behavior right now. Step 3. Check price location. Is price sitting near the upper band, the lower band, or hovering closer to the middle? Step 4. Look for a confirming signal from a second, independent source that could be a momentum indicator like RSI or MACD, or it could be a recognizable pattern like the W bottom or M top we discussed. Step 5. Only after all of that, plan your actual entry, your stop loss level, and your profit target, which we'll touch on again in just a moment. Running through these 5 checks takes well under a minute once it becomes habit, and it will keep you from making snap decisions based on nothing more than a single glance at the bands. Even with a solid checklist in hand, it's worth naming the mistakes most beginners still make, because I'd genuinely rather you hear these from me now than learn them the expensive way, with real money on the line. Mistake 1. Treating a touch of the band as an automatic buy or sell signal. We covered this at length. It's the single most common Bollinger Band error out there. Mistake 2. Trading the squeeze by guessing the breakout direction ahead of time instead of waiting patiently for confirmation. Mistake 3. Applying the Bollinger Bounce technique during a genuinely strong trend, instead of confirming first that the market is actually ranging. Mistake 4. Using Bollinger Bands completely in isolation, with no awareness of the broader trend, and no second confirming indicator at all. Mistake 5. Never adjusting your settings or time frame to match what you're actually trading. A setting that works well on a slow-moving index might be far too noisy for a fast-moving individual stock, and vice versa. If you can simply avoid these 5 habits, you're already ahead of a large number of beginner traders using this indicator. With those pitfalls in mind, let's get practical. Nearly every charting platform out there, whether that's TradingView, your broker's own app, or something else entirely, has Bollinger Bands built in as a standard indicator you can add with just a couple of clicks. The default settings are a 20-period moving average with 2 standard deviations, and honestly, that default works reasonably well for most beginners across most timeframes. I'd recommend starting there rather than tinkering with the numbers right away. As you gain more experience, you might experiment a little. Some traders shorten the period for faster moving, shorter timeframe charts, or adjust the standard deviation multiplier slightly for assets that are naturally more or less volatile than average. But there's no need to worry about any of that today. Get comfortable reading the default settings first, before you start customizing anything. I want to pause here for something that isn't specific to Bollinger Bands, but applies to absolutely every technique we've discussed today: risk management. No indicator, not Bollinger Bands, not RSI, not anything else, will be right 100% of the time. Every technique we've covered today, including the squeeze breakout and the W bottom pattern, will occasionally produce a false signal that doesn't play out the way you expected. That means every trade idea needs a plan for being wrong, decided before you enter, not after, a stop-loss level chosen in advance, and a position size small enough that a single wrong trade doesn't do serious damage to your overall account. Bollinger Bands are a genuinely useful tool for improving your odds and your timing, but they are not, and were never meant to be, a replacement for basic risk management discipline. Time to bring it all together with a fast recap before we close out. Bollinger Bands are 3 lines, a middle moving average, and an upper and lower band set 2 standard deviations away from it, expanding and contracting automatically as volatility changes. Reading them well means checking 3 things together, never in isolation: band width, to gauge volatility; price location, relative to the bands, to gauge relative highs and lows; and whether price is genuinely walking the band in a strong trend versus sitting at a true statistical extreme in a ranging market. And we covered 4 practical techniques you can start practicing today: the squeeze, for anticipating breakouts after a period of unusually low volatility; W bottoms and M tops, for spotting potential reversal patterns; the Bollinger Bounce, for range-bound, sideways markets; and combining Bollinger Bands with a second indicator, like RSI, which strengthens the confidence behind every single one of the other 3 techniques. That brings us to the end of today's lecture. Thank you so much for sticking with me all the way through. If there's one thing I hope you carry away from today, it's this: Bollinger Bands are a lens for understanding volatility and relative price position, not a crystal ball that predicts the future. Used with patience, with context about the broader trend, and with a second confirming signal, they become a genuinely valuable part of a well-rounded trading approach. Go practice on a chart, take your time, and resist the urge to jump into live trades until these patterns start to feel familiar to you. Thanks again for joining me today, and I'll see you in the next lecture.